All right, and we are live. Let me throw out a couple links real quick, see if we can get some more people in here. All right, looks like we finally got a couple people in here. Gonna give it about, let's see, we'll get started at about 9:05. Give people a second to trickle into here and see if we can't get a little bit bigger of an audience. What's up? Studying right now at the CFA. I think I know who that one is. How you doing? We got 9 people in here now. And we've got, let's see. Need to activate the chat box on the screen. There we go. Steve, how's it going? CA, we've got everyone in the chat. Love to see it. That should be popping up on the screen now for people who are watching on YouTube after this, so they could see what I'm responding to in the chat as opposed to me just responding to what looks like a bunch of nothing from the interface on YouTube. So we're going to give everyone a couple more minutes to get in. Gringo25, how's it going? Welcome. So it looks like we're already up to 14 viewers, 17 now. That's pretty solid. Love to see everyone joining in. We're going to give about 60 more seconds to make sure everyone who was planning on joining us tonight can make it in. And it looks like we're already having streaming problems. Hopefully, if anyone else is having streaming problems, please let me know so we could try to get that figured out. We did drop the stream quality to 720, so I think that should be helpful for anyone who was having issues before. Let's get this blown up as we get ready to go. And unfortunately, no, I cannot run your Robinhood account, Freddie. Would love to, though. Would love to. I appreciate the offer. Good that y'all's are working. Hopefully, I guess, no commas. Maybe if you exit out, come back in. Hopefully, it'll get a little bit better. Maybe mess with the resolution. But we're going to jump into it. We're going to start with a recap of what's been going on this week. And it's been obviously a pretty crazy week. We've been holding on to UWMC for a long time now. And it looks like that has finally paid off this week as it went up a huge percentage today. Let's pull up Thinkorswim. We've got this up here. 19.66 and then up another $1. So I think that's about, let's see, that's probably about a little over 30% of an increase on UWMC today, which is great because that's what we've been sitting back and waiting for. You know, one of the big things about the strategy is to remain patient. And even though we got into what was formerly GHIV, we've been holding it for that long, all the way back to December 9th. And we started at 1084. It got all the way up to, let's go look at the chart here so we can tell you all about our journey with this one. But it did get up to 1438 at one point, so that made the drop down to 7 even tougher when we got in down here. We got to see all the gains up here and then see all those go away once it finally got back down to 7. But, you know, it's finally good to have it bounce back at least a little bit. And, I mean, it's definitely more than a little bit. It's jumped up past $10 after hours, which is something that we really love to see. Let's go back to the profit tracker that we've got working. We've got our break even at 831. You know, obviously, if it runs up to $12, $13, we could have made more money. But even if we get these shares called away from us at 10, that means once this updates, these are all going to expire worthless. We'll pull a 31% return. And for how terribly against us this went, it's 7.75% at the call away price of 10, as opposed to when it was back at, 750. We've endured basically a 30% loss on this position. We're able to hang tight with our strategy, recover, get back up to 10, and pull a, what I'm hoping, if it stays this high by March 19th, we'll pull a 31% return on that. So that's been really the highlight of the week for us so far. I mean, the only thing we're losing from on this is the calls that increase in value so much that we're losing individually on that play, but not too bad. You go down to VGAC, relatively flat. PSTH down just under $1, but that's another one we talk about in the Discord a lot. Is we're just kind of waiting on Bill Ackman to announce a target. We've never been too worried about that one. We trust that he knows what he's doing, that he could bring a really solid company public. So we're just going to sit back, do the same thing we did with UWMC, hopefully not endure as big of a drop, but that's our plan on that one, and we're going to be sticking to it. So really not too worried about these. We've got the weekly series of calls at 30. If it bumps up to 30, we'll take it. But if not, we'll happily have this go down to 0, collect another $300 on that, and just keep it rolling for the week after. LOTZ, that's another one that really turned against us, I think, last week at one point, and then had a really solid recovery. Yeah, it got down to $8.07, which is something you're never really happy to see, especially with how deep we got into this one. We are in for 35 contracts, so that's a pretty sizable position, but definitely happy to see it hovering around 10, which is our max profit level. Even if it did finish, we can go to the breakout tab here for a minute. But even if it did finish at about, let's see, what is it right now, 980 is what we'll call that. Even if it finishes at 980, we're still going to be taking home a really nice 10.9% return. So that's something we're super happy about. Obviously, we'd love for it to keep going a little bit past 10, but we're perfectly happy with where it is right now. Things obviously could be a lot worse. So let's go back into what else we've got cooking this week. The ICLM position, we got a little bit lucky on that one since we were assigned and were able to sell calls on Monday when the market had jumped up a bit. So we've got a pretty nice basis on that. All in all, I think we're still in technically a losing position. Yeah, we're barely losing. Our break-even's 26.07, and it closed today at 25.97. So another one, I mean, I'm probably going to sound like a broken record when we're going through these, but we're just going to keep holding and waiting for it to spike up or just wait for our calls to expire and sell another. And this is the plan we've been sticking to this whole time. Obviously, we do have a few losers in here now between CLOV, VGAC, and Apple and AMD, not worried about those. ICLN we just talked about. SOL is one that's starting to get a little away from us, but there should be some inflated premiums on the back end because they have earnings next week, I believe. So we should be able to lower our basis pretty significantly on that one. UXIN is another really small play we have. We don't really need to talk about that one too much. ASRT, that was one where we saw some really solid option premiums. We could pull that one up on the chart as well. I think we got in around 90 cents. So, I mean, we kind of got lucky timing, I guess what you could call the bottom in the short term over the last week or so. Got in right around this point and it jumped back above $1. And when you've got one strike puts that expire in 2.5, 3 weeks, that's really solid value if you could be pulling 23 cents. I think percentage-wise, based on capital that we have at risk, if we go back over to this tab, yeah, it's a 29.33% return on capital risk. So that's obviously it's one of these smaller penny stock range type stocks, so we don't want to put too big of a position into it, but in the position that we do have, we're looking to pull a pretty sizable return on capital. I mean, I say it a million times, I feel like it's always the smaller ones that always end up being our best plays. If we go back here, I think SAMA is one that, if I could find it, I have no idea where it went. EXY. Oh, there it is, right at the top here. I mean, we got small play right there, 20% return. Let's see what else we got. POWW, our smallest play to date with 800 of collateral, we got 33% return. So it is kind of funny that it is always the smallest ones that have the biggest returns for us, but those also are in turn some of the riskier ones. So we do try to keep those plays as small as possible. CLOV, we touched on that a little bit, but we can go back and take a look at the chart on this one. They had earnings yesterday after hours. People were expecting a little bit better guidance. Didn't get it, although they were a little bit of a tease for us, unfortunately, since it jumped up to 1150. So we thought we were going to be in for a pretty good day on those, but unfortunately it dropped all the way back to 9. And that's one that's, I mean, pretty, not significantly, but decently below the cost basis that we're working with. CLOV, 1074 cost basis, trading at $9. We've got a little bit of work to do to get back on that one, but times like that, you just got to trust the process, focus on your other plays like UWMC, the ones that are winning. And thank you. We've got a new follower. I'm glad that alert's finally working. I'm sticking to it. Appreciate the follow. Let's keep on moving through this. And then we had the Wayfair call spreads that we have right now. I'm pretty happy with that position. I think yesterday afternoon, if you would have asked me if I would have liked to have gotten in, or I guess yesterday if you asked me what I would have liked in an ideal world today. We've got studying right now, CFA. Appreciate that one too. Thanks for following. I think, so getting back to what I was talking about, I think yesterday, if you would ask me what a perfect day was today, it'd be, plus 30% on UWMC. And then to top it off, we had a little bit of a pullback from Wayfair, which, these are some old red lines here, but our max profit point here, we have a short leg at 340. So as long as it stays below this level for the next week and a half, I think March 12th is the expiry we have on those, I think we'll be just fine. And to address some of the comments we're getting, is Papa Steve's asking if Hyliion is a good one for the HT wheel, and let me double check on the price. I think it ran up a bit, but then yeah, it does what it typically does, runs up, drops back, and then we look at the 20-day chart here, it gets down to 14, runs up to 17, you think, okay, whoops, it's ran away, I can't do this anymore, and then less than a day later, it's back down to 16. So I think this is a pretty solid entry point. I know we did touch on it a little bit on Sunday and in the newsletter, but this is one that we did exit our position because we were worried about a Goldman Sachs analyst report that came out that talked about battery technology, basically, since the premise of Hyliion. Oops, I guess I've had this graphic up the whole time and I just now am realizing it. So I guess we'll keep talking about Hyliion. Still getting the kinks worked out, but this is one that we pulled out of initially because there was a Goldman Sachs report. Basically, Hyliion's business was revolving around using natural gas to fuel cars and becoming more efficient in that regard. And the whole value proposition was that these huge freight companies wouldn't be able to afford overnight switching to all electric vehicles. So the service that Hyliion provided would be a really good move in the meantime for them. Once the regulations start coming down, then they kind of have to improve their fuel efficiency. But the Goldman Sachs analyst report came out and said basically, look, battery power is getting cheaper and cheaper, quicker and quicker than expected, which is going to make Hyliion irrelevant. So I thought they brought up some really valid points, and it's okay to change your mind on a trade and exit when you think that you're incorrect on something. It's okay to take a loss sometimes. There's no need to fall into that sunk cost fallacy of, okay, I'm down this much, I might as well stick it out, because objectively, I like to think of things from today forwards. If you're going to lose more money on it from today forwards, it's probably not a great idea to be in on that trade. So that's what we did with Hyliion. We exited the trade at $17 a share. So right now we're still on top from where we exited. This does offer another good entry point, but to get back to the question, is this a good one for the HT wheel? I think yes, since they did announce that they do have battery technology, which kind of nullifies that bear thesis that Goldman Sachs released. It's Tuesday night, so we've only got 3 days left in the week, but you're looking at the money puts that are offering 3.26, 224, 135%. If you do want to look and go the full week out, we've got some unbelievable premiums at the money. 8.14% at the money for Hyliion is insane. And honestly, it's times like these where I wish we had a little bit more buying power to our name, but unfortunately tied up in a few different positions that make entering new ones difficult. And back when the market dropped last weekend, that was definitely a lesson we learned the hard way, because it's one of those things where, yeah, obviously it sucks to have a momentary dip. The option selling strategies that we run, they're effective during dips because they give us the luxury of sitting back and waiting, lowering our cost basis and waiting for the market to come back up. The market can go down, but it's not going to go down forever. And using strategies like the option selling strategies we use to buy ourselves some time moving forward and wait for that rebound are super helpful. But with that said, you're looking at an adjusted basis, 16 minus, we'll call it, what's the midpoint on here? We'll call it about $1.20. 1480 adjusted basis if assigned on this, and if not, if it just even stays flat, you're looking at an 8.14% return in 10 days. I think that's phenomenal, and that's another one of these things. Quick aside here, we'll pull up the annualization calculator we have for a 10-day trade. Since 10 days is a little bit, you can't necessarily do every 10 days because sometimes that'll fall on a weekend. We'll just call it 2 weeks to be conservative. But if you look at that return, that 8.14% return, annualized is 669%. Obviously, it's going to be slightly better than that annualized, considering the fact that it's a 10-day as opposed to 14, but this is in an effort to be more conservative. That's still a phenomenal return. Even if you go further out of the money, you want to play it super safe. You want to sell 14.5 for midpoint of 39 cents right there. That's something we could do as well. That's a 2.76% return. And going back to the annualization calculator, that's still a 3-figure return. You're going to double your money in a year. And this is probably the single most, not the single most, obviously you can go all the way down here, but one of the more conservative plays even possible on this stock. You have a $2 cushion in 10 days, which is something I'd be incredibly comfortable with. And again, like we mentioned, I think to circle back and answer the original question we were asked, I do think this is still a great candidate for the wheel. Earnings are behind them, so you know that this premium is there because it's there, not because of some artificial event like earnings or some sort of big news that's pending for them. So yeah, to answer that, Highland, great one for the wheel right now. So moving on, we've gone through what we did during the day. I think a couple things that might just be interesting to talk about. We could talk a little bit about Zoom. They had a pretty crazy day. Earnings yesterday. And if we look right here, put our mouse over it. 50 cents estimated EPS. They hit $1.22. Big time beat. The revenue numbers, for whatever reason, don't pop up when we hover over this. But yeah, they beat on revenue as well. And they raised their raised their guidance going forward, which is another thing that is great. They're pretty much, we talk about 3 areas that are revealed during earnings. It's EPS, revenue, and then guidance. And they hit on all 3 of those, and that was reflected in the stock prices. They jumped up to $4.60 after hours. But one of the crazier things is what happened to them intraday today. They opened up, came down a little bit, opened up at about $4.40, which you would expect because, you know, when something runs up this high, it comes back down a little bit. Mean reversion is a pretty important concept with stuff like this. But the intraday move, even after such an incredible earnings report, incredible guidance, they fell all the way back to $3.71 at close. Now, I don't necessarily know what to make of that. We've got this red line here from a long, long time ago with a point of what should be support. It broke through it and came back up here. Bounced off it nicely here, and at the end of the day, back on the 25th. If we back up a little bit, I mean, let's just see. It's an old line, but yeah, it hasn't really tested it in a while. We could back up to the 180-day. Yeah. I think we were probably looking at this back in this area, or maybe a little further back. But, yeah, this is just an enormous red candle. You look at the last time they had a drop of this nature. They kept falling the day after, so that's something that would maybe give me pause. And then personally, I don't believe that Zoom is going to be able to continue the amount of success that they've seen so far. It seems like for what their business is offering, a pandemic quite literally is the peak bull case for this company. And now that we've got vaccines, things are opening back up. I feel like there's really only a way down unless there's some sort of revenue stream they think they're going to be able to capture, any sort of new type of business line they're rolling out. But as far as I know, nothing like that is on the table right now. So this is one I'm probably long-term bearish on, but would leave alone. I think if this spiked up any higher, I might be looking to play a call credit spread. But for now, I'm going to leave that one be. Next question in the chat, studying right now for the CFA. Would you sell a 319 UWMC 12.5 put? Good question. Let's go take a look at the options chain. So as you can see, we've got, as indicated by the red right here, we've got the covered calls we sold at 10 strike. We've got 7.5 strike puts that we sold, and we've got 10 strike puts we sold, all expiring on March 19th. So March 19th, 2.5 weeks for us is going to be a pretty big day for us. And I know a lot of people in our Discord, since we like to consider those monthly option expiries as kind of holidays in our Discord server, because that's when, you know, Theta Decay finally comes full circle, knocks 100% of the extrinsic value off. And I know we have a lot of positions throughout the group and in the chat of people who do have positions that expire on March 19th. But the question here, would you sell 12.5 strike puts? And to be honest, looking at the prices here might be a little bit misleading because it's run up at, $1.40 after hours. So that part, it's kind of tough to say. So, I mean, you could call it 380 right here, but we know that once the market opens tomorrow, that's going to be a little bit lower than 380. So, I mean, using these, it's tough to guess. I guess we can create something similar. We'll say right now that these 11 puts were $2 out of the money, and they were $2.35, $2.70. So right now, with the price of $10.50, the 12.50s are $2 out of the money. So we could pretty much just move these down a row and say that the 12.5s are going to be selling for about a midpoint of, we'll call it $2.50 for the purposes of this discussion. And again, that's something that would throw your break-even price at $10 a share, while still leaving a little bit of upside to 12.5, which, not too bad of a thing. But the only thing I worry about is when things run up like this, it's all right if we go back to the 20-day chart here. I mean, the entries we were making, we entered 7.5 puts here. I know a lot of people in the chat were entering on the way down, averaging down, which is exactly what we want to do with our strategy, because we wait for things to get beaten down. And when they inevitably, hopefully, rise back up like this, I would just worry that as far as an entry for tomorrow morning, you run into the problem where you're kind of chasing a little bit. Because I think you look at the RSI, and this is another thing, for those who aren't familiar, RSI is the relative strength index, and it pretty much gives you a measure of whether a stock is overbought or oversold. So anything over 70 means the stock is overbought and it's probably going to sell off pretty soon. Anything below 30 means the stock's oversold and poised for a bounce. And this is the 20-day that we're looking at right here, since that is the time frame that we've got the chart on. RSI differs based on what time period you're looking at, so that's something you probably want to be cognizant of if you're trying to use that as an indicator for any analysis that you're performing on stocks. But if we kind of trace the RSI, we could really see historically how accurate or inaccurate it's been. But the last time it got above the 70 level was right around here on February 3rd, where that day it ran up a bit, but the day after there's a pretty big red candle. So anytime it does get up in this red area, we could expect there to be a little bit of a pullback. And RSI is one of the big things I looked at for Wayfair. You saw it got extremely high on the 20-day up here, up past 80, up to 83. And that's really one of the big things in our bear thesis that we were looking at when we opened this call credit spread, thinking Wayfair was going to go back down, is the fact that RSI was basically through the roof, and you see it gets up into the red here, and it fell back down today. And you see, I guess we could look at another example, gets blue right here, falls down near 30, and then spikes right back up. So if you're looking for entry or exit points, RSI, I mean, I guess really entry points is more specific to the strategy we run, because exit points are dictated by the options that you sell. So when we look at entry points for what we're running, I think RSI is a really good indicator to figure out, okay, am I chasing something a little bit, or okay, is this stock something that's beaten down, something that is, let me finally hide this. I don't know why I've had this sitting up here the whole time. We are no longer talking about Hyliion, so I've taken that off the screen. But something that you definitely want to look at, am I chasing something that's overbought? Is this not a good entry point? Is it going to fall back? Or am I finding a good entry point on something that's oversold and is poised to bounce? That's what I typically use RSI for, and I think it is super useful in the context of what we do. But again, in conclusion, based off that RSI that we're looking at, which suggests this is going to pull back pretty severely at some point in the near future, maybe pull back to around, I mean, it's tough to even say the 9 level. I mean, I hope for the sake of our positions it holds 10. And it is one of those things where it could run all the way up to 15, and then the pullback could be to 12. You never really know when stocks are running up really irrationally like this. I mean, if UWMC had like a plus 5% day and RSI was up here, I could pretty confidently say, okay, it's probably going to fall back at some point in the near future. However, when it has a 30% day, which is entirely out of character for a stock like this, it makes this a little bit harder to decipher and kind of call when the top is. But I think what we always like to say is I'd rather miss out on a good trade than be stuck in a bad one. And I think with the possibility of this pulling back down to this 9 level, I think if you did sell 12.5 puts at open tomorrow, that would be the equivalent of getting stuck in a bad trade. So I think that's probably something I would avoid. Maybe the 10 strike puts would be something that were good, because those would be out of the money. I don't really know what we could infer that the price of these would be tomorrow, but I imagine you could probably still get a buck on them at open. That's something that would stick you with a $9 basis, and that's definitely somewhere I'd be comfortable holding long term. And then if they were a buck, that's a little over 10% return on capital risk, so that's in my mind perfectly acceptable for 2.5 week play if you want to get a little bit of skin in the game on UWMC. So I guess those are my thoughts on entering that stock at this point. If anyone else has any questions, any stocks that you want us to look at, throw them in the chat and we could be happy to address them. But until we get some more of that, we can keep moving down. I made a little bit of an outline for stuff that we could talk about. And kind of in line with this UWMC discussion is Rocket Mortgage, because obviously that was the big mover today. It went up 71.19%. That is just an insane move from a mortgage company. And it looks even crazier, obviously, when you back out and put it in the context of the 20-day or 180-day chart. So, I mean, it ran up from, these two red lines we have down here are useless. We used to use these to figure out when it had resistance around $19. So that's something that once this blows up to 40, there's no reason that these are even going to be useful anymore. But, point being, 71.19%, sometimes you'll see it on the meme stocks. Sometimes you'll see it on the penny stocks. When you see it on a mortgage stock like this, that's definitely something that'll turn some heads. So I think that's something that is probably the single biggest catalyst for the UWMC move. There was a little bit of news associated with this, and it was when they had their earnings, they announced that they were going to have a special dividend. And I think what that essentially boils down to is the fact that it's a stock dividend as opposed to a cash dividend. And since the shares were so heavily shorted, the people who are shorting the shares are responsible for delivering a decent portion of that cash dividend. So people ASAP are trying to get out of these shares, which creates this huge upward pressure in buying, the buying power and the buying volume that we saw over the past week. Good question. How do I find our credit spread positions? Do we run a separate screener for that? So as far as screening for those, we don't typically screen. As you can see, it's on my watch list. This is the wheel watch list. I just added it there for ease to be able to track it while I look at the wheel watch list. But I have this default watch list of a bunch of different stocks, and it's something that I'll watch throughout the day. And it's something I definitely recommend everyone have. I think we've got either between 25 and 30 on this, but just watching these throughout the day to day, week to week, and just understanding how each of these individual stocks move. So if you're looking for a position, you think, okay, the market's super overbought right now, I want to play something back down. You could just take a look down the list and see, okay, which price on these stocks is way higher than I think it should be or has any business being. And that's when we looked at Wayfair. It stuck out like a sore thumb because we previously had played Wayfair. If we take a look at the chart over here, we love to play this. This is what this red line indicates. We love to play it down off like the 310 level. And for the longest time, you can even look back here, it worked really, really, really well. It'd go up to this level, big red candle. It'd go up to this level, big red candle. Go up to this level, big red candle, until it eventually broke through, came back up, and it tested it again. So we got back in, and a huge red candle back to 230. And we said, okay, we don't need to worry about it anymore, until it came back here. And I think we played it again here. And then it got to the point a week ago where we didn't want to play it anymore until, of course, they had this huge run up to 320, 330, 340. So I guess to answer that question in short, we typically just look at the stocks on our watch list. If anything doesn't seem in line with what we expect, we take a look into that. We see if the stock move is justified by any news or company-specific information, and then make our decision from there. And do we focus on the 4-hour charts or the daily? That's a good question. I like to use a little bit of both. Obviously, 4-hour chart, when you zoom out to the 180-day, is pretty useful for analyzing long-term trends. Like we were able to pretty conveniently see this trend that I was talking about where it would consistently bounce off 310. If you're looking for some more long-term areas of support, like I think if you look this far out, you could see, okay, there's a peak back in late August of 2020 around 345, and guess what? That was almost exactly what it peaked at this week. So using the 180-day, 4-hour candle, things like that are really helpful when you kind of get into uncharted territory. If you jump in on like the 20-day, 1 hour, you see, okay, it's coming up past 320. It broke through our point of resistance that we identified. We don't really know where it's going to stop. That's when I think it's a good idea. Back up, look at the 180. Okay, we've got a peak here. We've got a peak here. We could kind of put two and two together and realize probably 340 is an area where it might hit the brakes and pull back a little bit, and that's exactly what we saw. And that's where we like to set our short legs on the spread, so that's why we opened a 340, 350 call spread, the 340 obviously being the short leg that we're trying to keep Wayfair below. So that's kind of how we evaluated that and made that decision to open the Wayfair spread. So it looks like we don't have any other questions right now, but we'll keep moving. We'll talk a little bit about one stock that we played a week ago, I want to say, maybe 2 weeks ago. We can go back to the profit tracker to be sure. LODE. Yeah, it looks like it was 2 weeks ago. week of 214, we had all these 5-strike puts that we sold. We were in pretty deep on that one. I think we originally sold 40 and then rolled half of them down to 4. We didn't actually have 60 of these right here, as you can see. But what we saw on that one, obviously, we 78-cent premium on 5-strike puts, and that was on something that ran all the way up to like 11.25 that morning and then pulled back to 5 is when we got in. So I thought that was some really solid entry on those, and that's why we took advantage of that play. But because of that, it showed up on my watch list, and that is why it is kind of back in the crosshairs now as something that I want to discuss on this. So we'll zoom in a little bit. We'll call it the 20-day because this is really all the relevant information we need to be making this decision. It ran up to it was trading in the $150, $2, $2.25 range. I think officially $2.30 before it spiked up on February 17th. And that was the day we entered. We entered right around here. But let's see. Yeah, it's getting back down below 5, 488, 481. So that's something that kind of piques my interest. The reason for the spike initially was the fact that they acquired I want to say lithium recycling company, which does have the implication, since lithium is used so much in electric vehicles, it does have the implication that this is going to become a stock that's tied to the future of electric vehicles, which, as we know, in the current market conditions that we've been in, that's something that is going to draw a lot of attention, as seen by the 11.25 spike on 217. And what that spike tells me is there is still potentially some upside here to get back up to that level, but at the same time, I mean, it's all in front of us right now on the 20-day chart. There still is a little bit of downside back to the 2 level. So what that tells me is I want to look for some solid return on risk. I mean, we could sell, even the 5 puts are almost at the money. They're 12 cents in the money. But if it gets above 5 and remains above 5 by March 19th, 21% return in 2.5 weeks, not bad at all. We could even give ourselves a little bit bigger of a cushion for strike for the puts, offering 35 cents a premium would put your break even at 365, which is right there on the chart. Not too bad. That's still below all the areas of support, so you've got a nice little cushion right there. And additionally, if we look over to the left side of this, it's also hitting this peak, so that's something that tells me we might even get a bounce off 380-ish. Or you could go with see if you can get 10 cents, maybe try to get a fill for 15. Pull between, I think, 3, 4, 5% on the 3 puts, which would stick you with the basis of 290, which is obviously the safest of them all, putting you down here. But again, this is another one where it's important to consider the downward potential, the downside of the stock. What we're looking at is the 20-day chart, and it's been on a pretty wild ride for the last 20 days. So I can't imagine the next, 17 days to get to March 19th at expiry is exactly going to be low stress. So that is definitely a little bit higher risk, but higher reward as identified by the premiums. There is a catalyst that maybe does justify it being up here with them getting into the lithium space. So whether or not that's materially altered the value of the stock to justify it being up here remains to be seen. There's still potentially the upside to 11, like we mentioned, but all in all, it's an interesting one. Not something I'd be sinking my last little bit of buying power into, but if you've got some cash freed up, you're looking for a trade, that could be a fun one to follow for a few weeks and hope the IV melts off these and you can collect some nice returns. And then let's see, moving down a little bit further. Next thing I want to talk about was take a look at SPY. There was something interesting I saw today in the overall market, S&P 500. And I mean, obviously I've made the point a lot, if we back up to the 1-year chart, this is the peak of the COVID dip, end of March. But since then, I mean, it's hard to believe today, looking back, that SPY ever got down to 218.26. But since then, it has been almost a straight line up. We had a little bit of a dip last June, a little bit of a dip last September, bit of a pullback in October up till the end of November. But other than that, it's been damn near a straight line up to where we are today, almost pushing 400 on SPY. And this is something that you always want to be wary of because, I mean, it's almost the largest, one of the largest stock indexes in the world has effectively almost doubled in one calendar year when historically it has a 9 or 10% year-over-year return. So that's something you really want to be cautious of moving forward, and I am really advocating not dipping into as much margin as you typically do. If that's something that you incorporate as part of your strategy, I think it's also smart to, even if you don't use margin, just keep a little bit of that cash available on the table for when we do potentially see something like July or last September, or last October. I mean, we went, let's see, there was a dip in March. We waited 3 months for another dip, 3 months for another dip, 1 month for another dip. And we have since gone, 4 months without a dip. So that's probably the longest stretch on this 1 year chart that we've gone without any significant sort of a pullback. We've got all sorts of concerns in the market about inflation. We've got concerns about if the stimulus comes out, what's going to happen after that. Are people pretty much done? Bond rates are rising, although those fears were mollified a little bit earlier this week, which is why stocks kind of jumped back up. And there was another thing that I wanted to bring up. And I'm a big fan of taking a look at historical charts and trends to try to get to the bottom of what's going on in the market. And this was a tweet that I saw today that I thought was super interesting. If we take a look at in the 70s, obviously you might say, okay, why are we comparing the 70s to right now? Might not be the same thing due to quantitative easing, but I think it is an interesting position or an interesting comparison because it is something, as far as stagflation is concerned, is a little bit similar to what we're seeing right now. I would argue what we're seeing is maybe unprecedented in a way, but at the same time, I think it is always useful for the sake of comparison to look at what we have available. So if we click over, this is obviously 1965 to 1964, and we've got one little trough, we've got another trough, a run up, and then a 60% drop in the market. And this tweet is from last July, but it's really similar in the sense that we have one dip, two dips, and this cuts off in July, but we know what happens. If this is, let's see, May of last year, this is right when the COVID recovered. So right around here is what we're looking at on that chart. And it's gone from, 322 up to 386 since then. So what we're at now is almost off the screen up here. But, and that parallels what we see right here, because after the second dip, it gets almost equally high, so that we could call this the COVID recovery, and it continues higher, which we could potentially call the equivalent of 390 right now on SPY, which is what we're seeing. And then they had a significant drop due to stagflation, which is something that we are concerned about in the current market due to some of the monetary policy that we've seen. But you can even see the skepticism in some of the replies to the tweet. The market internals have changed dramatically. Seems dangerous to pull up a 40-year-old chart and expect the current market to behave the same. So by no means do I suggest that we're about to see a 60% drop, but it is interesting to kind of look at parallels historically of potentially somewhat similar economic conditions. Like we mentioned, I know quantitative easing was not a thing back then, so the Fed wasn't just pumping money into the market to artificially protect drops in the stock market. But I think we definitely are due for a little bit of a pullback, and it seems like we might be reaching a bit of a peak here. But what they always say about bear markets is, not that we're in one now, but you get the biggest green days in bear markets. When you're in a bull market, back up to the 1 year again, don't even know why I zoomed in. It's normally just a steady grind upwards, as opposed to bear markets. You get the big red candles, but with the big red candles come the big green candles. So that's why, when the market pulls back, you still get these big green days, but the red days eventually are going to outnumber the green days. And that's what I started to feel like we were seeing last week. So if we pull up the 20-day, we've got this, I don't know if I'd call this a slow grind up, going from 370 to 395 so quickly, but we see these big red candles, and then, these big green candles, but still not as big as the red candles, which would lead me to believe, if we follow that pattern of what it looks like when the market pulls back, we might be in for some big red candles. But long story short, these are kind of the market trends that we're seeing and considering when we make these plays. When you're selling options, you're always inherently going to be hedged against a market pullback. So that's something that's always nice to have going on. But at the same time, as far as the amount of cash we have deployed in the market, when situations like this present themselves, we want to be sure that we have sufficient buying power to take advantage of when we do see a pullback, so that we aren't caught figuratively with our pants down like we were last week when we had this huge drop in the market and no money to use to buy up all the stocks on discount. So I guess that to kind of close the loop, that was the point of what we were going for with that one. Any other questions, stocks we want to look at, throw them in the chat. I'll be happy to pull them up, run some analysis. You can take a look at options change, potential plays. But moving forward, what we did do today was we made a video about GameStop. And that's something. Ooh, we got another one. Okay, TRIT, CLF, JMarts. We're going to take a look at both. Covered calls on MGM. We're going to throw those on in a second. What we're going to do is we're going to put our little graphic back up and edit it. I don't know. This is probably not the best way to do it. 1, 2, 3, 4. We're going to talk about TRIT first, something I have not heard about yet. So give me a second to put this in. Take a sip of water really quickly. All right. Okay. TRIT. Tried Terrace. We go back to the Analyze tab always, since when we come up with companies that we're not familiar with. Type that back in again. TRIT. They're a financial technology company focused on trade and trade finance. The company operates Kratos, which is a blockchain-enabled commodity trading and trade finance digital platform. JMarts, if you know anything about this one, feel free to throw it in the chat, because I feel like you're not just asking about this one for no reason, but this does look like an interesting industry, obviously, to be in. It doesn't look like there's a whole lot of interesting financial info. Let's take a look at the charts. All right. So I'm assuming this was one that was a SPAC at one point, because we do see what looks to be like a price floor at 10 a share when we back it up all the way to August of 2019. And you know what we see right here, what we like to talk about, the typical lifespan of, or timeline of a SPAC. You know, you have the merger potential target rumors, maybe the hype died off a little bit, potential target. I mean, there's a gap down from 13 to 8 here. That's not like anything I think I've ever seen on a SPAC, but maybe there was and then it jumped back up to 15 really quickly. I couldn't tell you what happened there. That looks like it's over the course of literally 10 days. So that's some pretty insane price movement. But one of these things where it looks like, if I had to guess, this is probably where the merger was. And then you get that SPAC post-merger sell-off, bottomed out at 6.5 and then down to 7.05. So in the scheme of things, pretty damn good entry point. If this is something you're interested in, want to get in on, let's take a look at the option chains. I mean, not a ton of volume, obviously, but I think there's still enough to do something with in here for sure. And I think this is, honestly, looking at these calls, some really solid value. You scoop these shares up at 7.05 a share. Sell some 7.5 covered calls for 50 cents. You've got almost a 650 basis right there off the bat, which, looking at the chart again, is the literal bottom. That's a pretty small wick on the candle, so it didn't spend much time there at all. Let's see if that's even back in the 20-day. Yeah, so that was literally 20 days ago when it went to 6.5 and bounced back up quickly. So as far as what that tells us, maybe 6.5 is a pretty strong base on this one. But either way, I think even not knowing what this is at all, that's something for a 2.5 week play that I would be pretty comfortable doing, because you look another month out, this premium is obviously going to hold up a little bit better, but you're still getting $1 on the April ones, which gets you damn near down to $5 on your basis in less than a couple weeks. And he says it's a bullish on blockchain, software as a service plays, and unique company. Yeah, I think that's definitely really interesting. We go back to what they were talking about in their company description a little bit, what they do. Financing options, supply chain financing, accounts receivable purchase, loan financing. Get to know your customer, anti-money laundering, digital contracts. I mean, and this is definitely the kind of thing that we like to look at, where I think if you hang around and lower your basis for long enough, it's in an industry where you could see a pretty big spike at some point. So you just keep lowering your basis week after week and just be patient and wait for a spike that looks something like this. So that's really something
I mean, not knowing a ton. I know we did look a little bit at the company description, but just from a chart compared to the amount of premium the options are getting, we could do one final thing and actually put some hard numbers behind this and go into our potential plays, potential trades breakout tab. I will call this, let's see, TRIT, and it looks like I may need to do something to the text at some point so it doesn't completely go away on the white background. But we're going to keep it moving. 705 is what it closed at. Started at, we'll call that 705 as well. And let's just say we purchased 100 shares of TRIT. Sold 1,319, 7.5 strike call for 50 cents of premium. Again, we picked the shares up for 705. That's going to equal that. So, I mean, we got to change the amount of collateral on here. This is poorly labeled, but the amount of collateral is going to equal. The way we're going to do this is going to be collateral at risk. So 100 shares times not 7.05 because that's the share price, but 7.05 minus 0.5. Since that's the call premium you're getting no matter what, you really only have 665 at risk here. So that's what we're going to call $655 as collateral for purposes of calculating our return. And what we like to refer to as the base return. So if TRIT stays completely flat between now and expiration, you're getting a 7.63% return on capital. And thank you, Papa Steve. Appreciate that. I'll definitely let you leave that up there a little bit. Thanks for the help the past few weeks. Of course, we appreciate you having us on. Appreciate having you on the Twitch stream. Appreciate having you in the server. Always appreciate the donations. So getting back to what we're doing, TRIT. 705, that's a 7.63% return on capital, just if it stays completely flat. And like we mentioned, this isn't updated yet, but 665 is going to be the break-even price. Excuse me, 655. Some solid mental math right there for me. 655, obviously, updates automatically. That's when we're at 0. But what's the really interesting part here is what happens if these shares get called away at 7.5, and that's when we get, I mean, obviously 95 isn't a huge number since we're only doing one of these, but a 14.50% return on capital definitely is a pretty nice number. So if we go back here, what are the odds that this actually gets up to 7.5? We can use some of the option pricing formula to our advantage there. If we do probability in the money, so probability that it gets to 7.5, and that's a 36.51% chance right there. Let's stay here a little bit longer so you can see what I'm looking at. Probability that it finishes in the money, meaning probability that TRIT gets to 7.5 is 36.51. And, I mean, giving yourself a 36.51% chance that you're going to make 14.54% in 2 weeks, or if we put, let's see, we'll call this 3 since that'd be the day that we started. For a 2,000% annualized return, that's something I would be very happy with, even if it stayed entirely flat at 705. Not to beat the dead horse here, but again, 7.63% return that annualizes to 433.11%. So that's not too bad at all. Another thing that I think is kind of fun to do is when we look at the sentiment on social media. Now, typically, this is something that is going to have some serious confirmation bias because people just love to go onto Twitter and pump stocks. Yeah, well, this is going to be us drinking the suit's tears if we continue to hold. Okay. Not a lot of deep analysis, obviously, on Twitter, but sometimes there's a little bit of good info hidden among the mess. Like, here we go. Fintech company. I mean, they've cut off the analysis that they had here, but let's see if we can find anything remotely. Educational posts. This looks like a bunch of just coping. Ooh, so, okay. This is interesting here. It looks like they have a short report out on them. Oppenheimer analysts, they downgraded them to outperform. Short report. Because the auditor resigned. Okay. So this is a little bit, this is interesting. Let's see if we can get an actual copy of the short report. I don't know. So, I mean, it is a little bit suspicious when an auditor resigns because typically, in my experience with seeing financial statement audits, they normally go pretty smoothly, and it is tough to find yourself in a situation where your auditor just completely would resign from issuing an opinion on your financial statements because they felt that uncomfortable with what they read. So that's definitely a little bit suspicious. And like we mentioned, the downside risk is always a big consideration in this strategy. So maybe this is one to stay away from the more that we look into it. And again, that's a little tidbit of info that we got off Twitter. Another good way to find info is going over to the charts tab and hitting live news. And that's something, that would have popped up here, 125. They announced an independent investigation to address and rebut the recent short report. And then they keep popping up on these little scanner articles where they talk about 30 high short interest plays. And I mean, no surprise there, seeing GameStop at the top of that. Rocket Mortgage, number 4 for whatever reason, and that is a huge reason why we saw what we saw today. Let's see, there they are, number 7, 32% short interest. So, I mean, maybe this is one that could have a similar type pop that we saw with UWMC. Let's take a look at some of these other names on here. SKT, Tanger, Factory Outlet Centers. Let's see how that's been looking. High short interest. Look at that big green candle. If we go to another one, we've got Academy Sports and Outdoors, ASO. Relatively flat, so not a ton going on there. Rocket, obviously, a huge green candle today and this week. GoGo, this will be the last one I look at really quickly. I'm just, for curiosity's sake, seeing what's going on in general with a lot of these. Good point. Okay, yeah, you mentioned J-Marts. That was the last drop on the chart to this level. Makes sense that they would drop on a short report like that. And again, it doesn't seem like any of the news that we look at, TRIT, has too much information about the short report itself, other than the fact the only really negative thing that we saw is the fact that the auditors resigned, which, you know, obviously pretty big red flag right here. Yeah, replacing KPMG LLP as the independent auditor. All right. So, I mean, looks like that's the news. There may be some sort of potential. And another good question before we get to CLF and MGM. How often do you close a put early if you can make 50% max profit in a day or two? So, I mean, I think I might approach this in a way that others don't necessarily, but I'm always of the opinion that if you have the opportunity, I mean, if you've made 50%, you've got to think about why you entered the trade in the first place. Like if I sold a 10 strike put on something that jumped up to $13 and I've all of a sudden made 50% max profit in a day or two. Why did I sell that 10 strike put in the first place? It's because I'd be happy to buy the shares at $10. And I think if something jumped up to $13, that wouldn't change the fact that I'd be perfectly happy to buy the shares at $10. I think personally that's something that would even make me more comfortable with purchasing the shares at $10 a share. So, I mean, I personally hold on even if I've hit 50% of max profit because I would at least like to see mid or maybe low to mid 90% max profit before expiration if I were to close it out early. The only reason I would potentially close it out early, using the same example that we just talked about, is if I were at, again, we're playing that stock at 10 and it jumps to 13, we're at 50% max profit. If I wanted to collect a little bit more premium, close those out, and then open like an 11 or a 12 strike or 13 strike put to collect even more premium, I think that's when I would be closing it out, but it really would just be me rolling it higher as opposed to just fully closing out the position. Now that guidance is a little bit different for spreads because when spreads move against you, you're kind of SOL. There's not a lot of recourse. I mean, you could roll a little bit upwards or downwards depending on call or put spread, maybe once or twice before you're in a little bit over your head risk-wise, but with the H2 wheel strategy we run in the context of what we're doing, even if you're assigned and that stock that went from 10 to 13 goes back down to 9 or something, I mean, we're okay. We'll take assignment at 10 with probably an adjusted basis down near 9, and that's something objectively I'm perfectly happy with. And looking at expected value, taking that approach at evaluating that situation, once it goes from 10 to 13, you're even more likely than you were before to collect that remaining 50% of profit. So the fact that, you know, I'd be okay assigned no matter what, and the fact that it's now more likely for me to collect that second half of profit, I tend to I tend to be partial to holding on and just letting it expire, waiting until we see low to mid 90% profit on those. But I think a lot of people, when you do, if you look at other options, courses, or learn from anyone else online or things like that, not that you would talk to anyone else online, come on, but they would probably tell you that it's probably best to close that out, take that 50% and move it to where you think that capital could be more efficient. But I'm not saying they're wrong. I'm not saying I'm right either. I think it's one of those things where it's either or, just personal preference about how you feel on that play after you have gotten to the point where you've made 50% max profit in a day or two. So that should I should address that. Moving on, next we're going to go to MGM real quick before we go to CLF, because we did cover CLF on the stream on Sunday. So MGM, a lot of people know MGM Resorts, the big, I guess I can give you the full official description of the company. This was suggested by Green Goat 25. Shout out to Green Goat for suggesting MGM. And again, one sec, we're going to update our little text box. Okay, that should be updated. We are talking about MGM. Here we go. It's an international holding company through subsidiaries. They own and operate casino resorts. The company operates in two segments: domestic resorts and MGM China. Domestic resorts segment consists of non-gaming operations, hotel, food, beverage, blah, 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 blah. You guys, I'm sure, probably know how a casino works. So that's their game. That's their business. That's what they do. Let's take a look at how they have performed. We're going to start broad scope, then zoom in, and then take a look at the option chain to make a decision about what we think is a good idea. So starting with the 1 year chart, we look at the peak of the COVID crash, or I guess you could say the bottom of the COVID crash. They got down to $5.90 a piece and have since run up pretty quickly. So a really high number at 38.54, but that's really a trend that we've seen across the industry. Like if we look at Penn Gaming, this is probably a pretty extreme example, but they bottomed out at 375, got up to 125.13. DraftKings might be a little bit different because they're, DK and G might be a little bit different, but 17.6 up to 70 now. But the whole casino industry as a whole has seen that similar trend as COVID fears have waned, and it looked like a lot of these companies aren't going to be needing to move into bankruptcy and that the shares are going to be worth something. So that's definitely still the case here with MGM. And as you can see, good lord, the implied volatility was through the roof on this one back when all this was happening. Taking a look at the RSI, it is a little bit elevated on the 1 year. I think we might get a better picture about entry prices if we zoom into the 20-day here. So I guess we've seen what we need to see from the 1 year. Went from 5.9 to 38.54. Typically, that's something that would turn me off to a stock, because I think typically we see something like that on penny stocks and things like that aren't necessarily strong. But MGM, well-respected brand, they have an established business, they've been trading for a while. We could even back up to the 3 year and see they were right around here before the COVID crash, peaking back in 28. Not peaking, this is just the 3 year obviously, but they were at this level at about 2018. And since they were able to survive the COVID crash, their business is going to be coming back pretty strong. Legalization of gambling, I don't know if they are in charge of administrating any of the potential online games that could come into effect once individual states start legalizing gambling, but that's another pretty bullish area for that industry in general. So if they're involved with that, which as big of a brand they are, I would assume that they are, that's something I think is another potential bullish catalyst. So let's go into the 20-day right here. From 20 days ago, 28 up to 38. This is where I would maybe give a little bit more pause, since it's run up, $10 on 28 is almost a little over 30%. Let's see. We see lost connection. Is anyone else having issues with the stream right now? Let me know in the chat if you're still able to see what we're doing here. Okay, appreciate that, Todd. Let me know. Awesome. Appreciate that, guys. And I guess I'm sticking to it. Just try to refresh. We've got it down to 720p, so I think it should be working for as many people as possible. I know we streamed in 1080 last time, so that might have caused some issues, but your iPad was having a problem. Okay, appreciate the feedback, everyone. Thank you. Glad you're still tuned in and paying attention an hour into this. So again, backing up, talking about MGM again, 28.56 to 38.62. I mean, to put an exact number on it, let's get a calculator over here. That's not what I wanted to do. I didn't want to make it that big. Or that big. Good Lord. Barely work a computer in front of you guys. But MGM was at, let me move this again so I can see the exact number. This is turning into a shit show with this calculator. Okay, back in action. It's gone 38.62. It's gone up minus 28.56. It's gone up $10.06 divided by the original 28.56 means that it's gone up 35.22% in the last 20 days. So, I mean, that's an enormous, it quite frankly is an enormous jump in the last 20 days. And one of these things where we talk about RSI, if we back up to the 180 day, it's still not overbought. So that's definitely encouraging. And as we can see, just kind of hammering home the point of why we use this RSI indicator. Every time it gets red, you see some red candles in there. It gets red again, you see some red candles as a pullback. Another issue where we had red on the RSI, some more red candles. And that's, I'm not going to follow this all the way to the present, but at this point, you should kind of understand that this is a pretty reliable indicator about whether or not something's going to go up and down, up or down rather. So, there was a drop up from 40 back down to 35. It looks like we're in the clear for earnings. Their last conference call was February 10th, so we're probably about 3 months out on their next quarterly earnings call, which I would expect to be sometime early to mid-May. So as far as things like that potentially pumping up premium, we don't need to worry about that. Let's get back into the 20-day. As far as an entry point, it might be a little bit elevated, but we could always compensate for a bad entry by selling some solid premium. So let's take a look at what that looks like. And let's switch this back to return on risk for us. I got to be honest, on a week-to-week basis with the potential downside down to 28, I don't know if this looks like that great of an investment. I think gambling stocks in general are pretty overextended right now. So while it is an industry I love for the long term, it's one of those things I think you could be long-term bullish but short-term bearish. I mean, Penn is just kind of a microcosm of what I think is going on with the whole industry where, again, not to keep hammering home the same points over and over throughout this analysis, but it's run from 26 to 126 without, obviously there have been some movements within the United States for legalization of sports gambling, but at what point is all that across maybe even the entire United States priced into a stock? So not often do stocks keep running up and up and up and up like this without, a decent retracement back to normal levels, what we consider like the mean or the median price levels. But I think, long-term bullish on gambling, but in the short term, this might be one that you want to stay away from because run up a ton recently. There's a little bit of downside risk here back towards the 30s. I think I would love to set a price alert on this one right around 30. And if it hits that, absolutely jump in because as you can see a lot of support and resistance in this low 30 areas. I think that's a much better entry point. But for now, it's really only offering $1 a week at the money. So even if you go a buck or two out the money, you're not getting too much value on this thing. And if it pulls all the way back down to $38 in a couple weeks, you're looking at a pretty long climb back up. So in conclusion, just hang tight on MGM. That's what I would do if it were me. If you're super bullish, obviously, your money, jump into it. I'm not going to sit here and say I'm 100% right about all the analysis I do. So if you have some conviction about a trade like this, absolutely jump on it. But just from the analysis we've done here, looking at the premiums that we see in the different options and the chart that we're looking at, and just really the movement within the industry as a whole, I don't think this is the best entry point. And again, like we mentioned earlier in the stream, better to miss out on a good trade than be caught in a bad trade. And with the kind of run up that we've seen lately here, I think you're much more likely to potentially be caught in a bad trade on this one. So that is my 2 cents on MGM. All right. Next one, we're going to get to CLF. We did talk about this a bit on Sunday, and I think I already know what we're going to see on this one because it did run up after I said to maybe wait. But again, like I said, I could be totally wrong on my actual analysis about stock movement. The way I look at things is with safety in mind and downside protection in mind. So that's kind of the approach I take. Not everyone needs to have the same investing philosophy as me, but I do think it is super helpful if people take a similar approach with the way that they play their investing thesis through an option selling strategy. No problem, Green Goat. Glad you're long MGM. That's probably been paying off really, really well for you lately. So happy to see that. So now we're going to get into CLF, update the old graphic really quickly, and we're going to keep things rolling. So we looked at this one on Sunday, and we came to the conclusion, honestly, I could pull up my email newsletter and tell you word for word what we said. I hope I can. If I have to sign in, I don't know if I want to do this. Come on. Log me in. Remember me. Perfect. So if we go back to this newsletter that we opened, you're seeing the old behind the scenes on the newsletter. I really just wanted, I don't know what I'm looking at here. I really just wanted to read it. All right, so for whatever reason, how about this? Easier way to probably do this is replicate it and then edit it. So it's good. You guys get to watch me mess around with my computer an hour into the stream. Super useful from a market analysis perspective. Okay. Now we've got what we sent out. We talked about CLF, the mining company, is one that's run up to a really nice number lately, but fallen back down a bit off the recent highs due to a poor earnings report. And again, like we mentioned, we love the fact that it had weekly options. We love the opportunity week after week to chip away because we know so many of the plays that we make in here are on monthly options. So you have to be a little bit more patient, which can be a good thing and a bad thing, depending on, I guess, your approach to the market. But we always do love the added flexibility of weeklies. Let's see. We blah, 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 blah. Additionally, the options offered really nice returns from an ROR perspective, which is still kind of the case here. I mean, 2.29% now. I think they've cooled off a lot lately as opposed to when we looked at them on Sunday. Although I'll tell you what, maybe not. Let's see, where's Monday? Yeah, this is Monday right here. And implied volatility has jumped since Monday. So I think we are seeing elevated premiums as compared to what historically, I mean, not historically, well, pretty much today and yesterday, what we have seen on those. So, I mean, really from a return perspective, I guess you do have to keep in mind that this is really Wednesday, Thursday, Friday, just 3 days of premium. If we look out another week, we're getting 469,283. Let's see. I mean, I do, not to be like doubling down on something I may be wrong about here, but I was at a low of 490. I mentioned on Sunday that I think the 8 or 9 range might be a little bit better to wait for, and I could justify that by backing up to the 180 day where we see, where's the 8 or 9 range? It's right around here where the stock was hanging out for a little bit before, jumping all the way up to $19. And, it does make sense. We do like to talk about support and resistance a lot on this channel. And if you look right where this bounced off, there's also some other bottoms right here. Back on December 29th, it bounced off this level. December 18th, a whole 1 day back. December 15th, so pretty much most of the back end of December. Thank you, Nightlife Live. Appreciate the follow. Always happy to have some new followers on board. But I guess getting back into what we're talking about, support levels are relatively consistent. That does go back to our conversation about why we do like to take a look at the 180 day, then the 20 day, and then maybe even the 1 day, because I think getting the multiple perspectives on the behavior of a stock over different time frames is super, super important in your analysis. But again, another one, could this fill the gap back up to 1673 before it dropped? Sure, we'll zoom in right here. But what we're seeing, we'll talk about support and resistance again. The support when it was, I guess, back end of January was right around $15, and it's now approaching that again. So if I had to guess, if you made me make a guess on something like this, I think it bounces off 15 and heads lower the next week or two. Again, could be totally wrong. I'm not a psychic. If I knew what a stock would do, I would be rich beyond my wildest imagination right now instead of doing something like this. But the best thing we can do, since we are not psychic, is do some good analysis, use option premium to our advantage, and just make some educated guesses, put ourselves in positions where we have positive expected values on trades and let the rest take care of itself. And honestly, it's been working out pretty well for us. Just to go back to our 2021 performance so far, we've been honestly blowing SPY out of the water. We did have one little hiccup last week when we screwed up managing our buying power. There's a pretty big dip in the market, but Right now, it's like that never even happened. We made that back and then some within 2 days of this week. That's a little bit of a tangent, just about trusting the process that we're in and understanding that things may not look good in the near term, but they'll be good in the long term. So just stay focused on that. But back to CLF again. I think we're hitting what was previously support, should act as resistance. So what we'd like to talk about a little bit earlier in the stream as far as an entry point is concerned, maybe not the best from that perspective. So again, personally, one I would stay away from, but if you do like the fact that, it's in the mining industry, there's a little bit of upside here potentially to 20. Although I'll tell you what, if you wanted to sell a 15 strike put, that'd stick your basis at what, 14.50, but cap your upside at $15 a share. This is one, since it's so volatile and, could potentially fill this gap up to 16.5 or 17. I'd almost consider going straight into covered calls. Just going maybe a week or two and then going out the money. A few strikes, 16.5 would offer you 30 cents. Obviously, you'd have to wait a little bit longer as opposed to the weekly ones where you could just be collecting premium week after week, day after day, basically, when you're selling the weeklies like this. But with the volatility of this one, I do think maybe you want to leave yourself that upside potential. But obviously, the safer play is that 15p you suggested, even safer, potentially going down to 14. And just accepting the fact that even 1.23% in 3 days in the market is still a really respectable return. So that's kind of my spiel on CLF. I do personally not something I'd be jumping on. But again, like I mentioned, none of us really know what's going to happen in the market. And anyone who pretends they do is kind of full of shit. So we're going to keep moving with that in mind, but that's just my opinion based off my personal investing risk tolerance and just what I've seen in the market. And then let's see, moving on, any other things in the chat? We'll check back in. How do you balance your life between everything? So that is one thing. I do work a job that has a good amount of hours, and I would be lying if I didn't say that working from home has really made a lot of this possible lately. So that has been a huge help. And then the great part about this strategy, and this is something, again, that I say all the time, is that it's not really time intensive. You'll go maybe watch other streamers or other people on YouTube who buy options and do day trading and are flipping stocks, every minute or every hour, and are just glued to the charts and hovered over the screens. But we don't really need to do that. And I think you'll find, at least what I've read from my research, is that most people who day trade or buy options and do things like that, they don't make any money. So what are you putting all this extra effort in for? It's really just, from my personal perspective, and this isn't to say anything against you if that's something that you do for yourself right now, but the amount of effort you're putting in for what you're getting out of it really isn't a great trade-off, as opposed to doing something like what we do with our option selling strategies, where we spend literally maybe only 5 actual minutes a week just setting up our trades, and then just spending the remainder of the week letting those work out. And as you can see, that works out very, very well, relatively low stress, low maintenance, and it's just really the perfect strategy for anyone who isn't doing this full time, because it's not very time intensive. If you have a job, if you have something else you need to be doing during the day, you don't need to be glued to your phone just staring at the screen looking for entries and exits and chart patterns and this and that and this. Oh, the IV spiked, I need to get out now, blah, blah, blah. When you get into trades like this, you know what your max profit is, you know your max loss, and you know the day of expiry. And all you really have to do is watch the stock price maybe a couple times a day and just keep things monitored. So that's something that helps a lot. Appreciate that, Green Goat. Glad you've been tuning in for this. Always appreciate the donations. Let's see what we're going to move on to next. So we've got that donation message in the screen. I've got it up there 15 seconds. I might make that a little bit longer. You guys got to put some better messages on there. I do appreciate the thanks, but you get a little bit of screen time. You might need to throw something, a little personal shout out up there or something. I don't know. Just a suggestion. But let's see. Moving on. That looks like that was kind of the end of what we had in the chat again. And even just general questions like that, any even non-trading related questions we could address. I mean, it's a Tuesday night. We're just talking on the stream, but we'll keep moving with more market related stuff if we don't have anything else. And that will take me into what I was doing today, actually, because luckily I do have a decent bit of free time today. So I was able to, any thoughts to open up voice chat in the Discord? Okay, that is a good question. It's something I've thought about, but I guess we could do that as well. I think this was kind of the one forum that I did plan to just be speaking in. And I know a lot of the time voice chats in the Discord can get a little bit crowded when you've got, I mean, I think we're up to about 1900 people in our Discord, and if we open that up to anyone, things could get a little bit hectic, but I mean, we could open it up and see what happens. So that's nothing. Appreciate that, Hal55. Always appreciate the new followers. Welcome to the club. So yeah, back to that topic about the voice chat. I mean, we could go for it. Worst thing that happens, it doesn't go very well, and I take it back off. But that's definitely something we could add to our Discord chat. And anyone who does have suggestions or criticism, constructive criticism, hopefully, or any other feedback regarding our Discord chat, I'm always happy to hear that and improve it, because we're trying to do the best we can to make things as useful as possible for you guys as we go through this. So moving on, what I was going to be talking about was the fact that, during the day, I had a little bit more free time today, so I was able to put together a video, which I hope I will be able to, not hope, it's done. I'll be able to upload it tomorrow morning. But it was about one of the stock market's favorite stocks right now, GameStop. So I'll put that graphic back on the screen. Glad we don't have Hylion showing for the first 30 minutes of the video anymore, and I've finally got the presence of mind to update that as we move from stock to stock. But I was able to make a video on GameStop, and I think it would be interesting for, I guess, now that we're on the back end of the stream, to potentially just go through what I went through when I did my analysis in the video. So let's pull the chart up. We're going to start with the 180 day. We always like to start with a little bit broader of a perspective before zooming in and looking at the more recent trends for entry and exit positions. But, if you haven't heard about this one, you probably just haven't been paying attention, because I think there were a good couple of weeks where everything stock related was talking about GameStop, talking about AMC. One of those things where people in your personal life would be asking you, oh, you done anything with GameStop? You done this? And I think it's one of those things a lot of people would largely agree that when you've got people who have never traded stocks in their life, who are all of a sudden acting like they're these high rollers and asking you about stocks and looking to get in on things like that, that's when hype is kind of at like an all-time high. And I think that's definitely what we saw with GameStop in the back end here of January, when it spiked up to $513. But obviously, huge short squeeze that was powered by the insane amount of short positions that were opened by hedge funds, namely Melvin Capital, which is a hedge fund that had their name show up a lot in the news as a result of being involved with that position. And they obviously kind of got their ass handed to them a little bit when this stock blew up. But it fell back down, which is what everyone knew would happen, but it was only a matter of time until it did happen. I know we have a user in our Discord channel. I'll give him a shout out right now to Alex, who I don't think he's making this one because he's out of London for us, but I hope he'll be watching the YouTube review. And he had a call spread on GameStop that, call credit spreads, they're bearish. He was playing the stock to go down, probably about in this range. And long story short, it squeezed on us, so we were staring at a max loss. We were staring at a max loss in the eye. And what happened was his short leg rather, I think it was like a 50 call. He might have to correct me on that one, but he got assigned on a 50 call. So essentially he had a huge short position where, if GameStop were still trading about 50 or 60, it's not the biggest. It's maybe a $30,000 short position. But since it ran up to 300,000, I believe he had essentially a six-figure short position in GameStop. And while for future reference, and I know he knows this now, the correct move is to close both legs out, close both the short position, and then sell the long leg of your option. He did one at a time, and I believe he closed the short position first and then held on to the long leg. And before he could close out the long leg, GameStop got halted. So for about 5 minutes, he was sitting there with these options that were worth into six figures, I'm sure, but his account was not into the six figures. So he essentially was holding a position far greater by a few multiples than his account balance, which is obviously not a fun thing to be doing on a random Wednesday or Thursday morning. Definitely a little bit heart attack inducing. You don't have to drink any coffee that morning when you're holding a $200,000 long position on a stock that's being short squeezed and halted. So that's to say the least. But long story short, after he sweated out for those few minutes, the stock got unhalted. It jumped up a bunch, so he made a really good amount of money. I think he may have doubled or tripled his account balance, period, on that one. But super lucky, but just kind of a fun story that I think I'll always remember when we talk about this initial short squeeze on GameStop. Obviously, it could have gone the other way, but we're glad for his sake that it did not, and he's got some more money to trade with now, and we're glad it all turned out okay. But just a fun story we like to tell about that first GameStop squeeze. Sleepy Condor, welcome to the chat. We're glad you finally got you in here from the Discord. Glad to have the only member right now in our Discord who has made $100,000 in profits from the time that he joined the Discord. And we have not had our Discord hasn't been around for too long. I think we started it up maybe last July, last August, but Sleepy is the first member of our Discord to hit that $100,000 profit mark. So if you need any proof of concept of what we're running in here, I think he is Exhibit A. He's done a great job of implementing what we do. He's really one of the more patient and strategic investors in the context of the strategies we use, and has even moved on to some more advanced strategies like Jade Lizards, which I think have been super interesting and really just represent that next level of knowledge because July 28th we launched. Well, there you go. Thank you for the fact checking me, helping me out right there with that one. July 28th we launched. So less than a year, long story short, is what he has accomplished. But definitely one of our favorite members to have in the chat, even though we love all of you equally, especially those who are here with us watching this right now. But back to the point that we were talking about, the GameStop short squeeze came back down inevitably. One of those things you always knew it was going to come back down, but you just don't know when. I mean, I personally was wrong maybe 5 or 6 individual times on this. I think when it was at 40 or 50, I was like, okay, the squeeze is over. I think you could probably find, not probably, I think you could definitely find messages from me in the chat when it went from 50 to 60 of me saying, okay, that was it. That was the squeeze. And then maybe 60 to 70. I was like, okay, well, that's it now. I think the squeeze is over, even up to 90. Despite many people in the chat telling me, hey, this is nothing. But obviously I could not conceptualize a move like this happening. So admittedly, hand up, I was wrong on that one. But getting back to the main point of when things are squeezing, you don't know how high they're going to get. You just know that eventually they're going to come down, but you can have any sort of bearish position just completely wrecked in the meantime by such a steep upwards move. So it's really no use in guessing. But getting back to today, which is why we're talking about the stock right now, after getting back down and leveling around $45, $46 a share for a little bit, which, I mean, this thing trading within a $10 range for what, 10 days is essentially the same as, whatchamacallit, essentially the same as basically no movement at all for how volatile this thing had been. How it looks like he bought puts when it was at 350, got IV crushed even when it went down to 50. I mean, exactly. I mean, if we had to maybe choose one example of why we sell options, even though it's a pretty extreme example, I think what happened to you with that is exactly what we would pick. You could be completely right, as you were, about the direction of the stock, but there are so many factors working against you when you buy it, especially on something as volatile as this, that just make finding profitability difficult. So obviously that's a shitty break to have happen to you, Hal, but one of these reasons, because this is something that happened to us all the time. We like to talk. I wish I could pull my phone up on the screen and show you my Robinhood account back from when I bought options, because I got cleaned out of, I think, $20,000 pretty quickly. And that is me being my stubborn self is when I finally decided that 20 grand was the mark before I took a step back and realized, okay, something is going very wrong for me right now, and I got to figure out who's getting all this money that I'm losing. And that's when we switched to the option selling side of things. Now I'll throw a screenshot of the Robinhood chart in the Discord after our stream for you guys' viewing pleasure. So that's something we could do. Give me, what are we doing right here? All right, back to GameStop. Let's see. Again, begs the question. We ran from 47, almost deja vu with the initial short squeeze. We went from 47 up near 200 a share after hours one day. And it's honestly, surprisingly, maybe settled back in this 120 area. I thought once we were touching 200, I mean, we were potentially seeing something like we were seeing before. And one thing that I think is super interesting, and I actually directly do this in the video, is this website that talks a little bit about the fundamentals of a short squeeze. It has the squeeze been squeezed? I think. Has the squeeze squeezed? This has to be it. Yeah. Is the squeeze squeezed? Excuse me. But basically what they do is they take, at a high level, some of the most important things about... we got Sleepy in the chat complaining about making max profit on a 60 strike covered call. All right. Enjoy your money, Sleepy. But no, obviously it does suck when you sell a 60 strike covered call and something runs up to double that price. That's I guess what you could, I'm doing air quotes right now, I don't have the webcam, but that's what you could call the risk of the strategy that we're running right here, is that you limit your upside. But at the end of the day, as long as you're picking a strike where you'd be happy selling those shares and it's objectively a nice gain on a week-to-week or month-to-month basis, you're going to be just fine. It does get tough, like for this example, when you sell GameStop 60 strike covered calls and it runs to 200. That's definitely a tough pill to swallow, but it's an easier one to swallow when you look in your accounts making money when you made a potential mistake, as opposed to losing money when you made a mistake. So getting back to this website we were taking a look at, is the squeeze.com. Gives you these high-level overviews, basically, of what different elements go into a short squeeze. And short interest, obviously, is a big one. 17 million, that's the amount of shares that are currently being shorted. The borrow rate, which is when you short a stock, you have to pay, I guess let me back up. When you short a stock, you're borrowing the stock from someone else to short sell. So when you borrow that stock from someone else, you pay interest to the broker. And currently that interest rate is 3.1%. Nothing terribly groundbreaking on that line. But then the other thing is borrow availability, meaning the amount of shares available to be borrowed before no more shares can be shorted at all. So that's 58,177. And that's something that is pretty important. I guess, they pick the three most important aspects that decide whether or not something is going to be short squeezed, and have come to the conclusion that there still is potentially a little bit more juice in GameStop based off what they're looking at right here. So that was something that we took a look at and analyzed in the video that we made today. So what we did at a high level is we said, okay, GameStop's back in the news. You're making the decision. Do I want to buy it? Should I get in right now? And obviously I'm a lot more conservative. Well, sometimes I'm a lot more conservative with things like this than most people, where I would say, look, February 24th, I'm sure you knew GameStop was trading at $52. If you didn't want it there, what makes you want it at $120 now? And your answer to that could be, you know what, now that it's spiked up like this, I think we could see another short squeeze. And to be honest, that's a completely fair conclusion as to why, or completely fair justification as to why you didn't buy at 50, but now you suddenly want it at 120. That's something, I could get behind that idea. And that is an idea that I kind of analyzed a little bit today when we took a look at the stock. So to back up a little bit further, what I did for the video was say, okay, you are someone who is saying, should I buy GameStop? There are really two reasons that I could think of as to why you would want to buy GameStop. The first is that, you think this business transformation that they're undergoing is going to be super successful. You think their shift from brick and mortar stores to being an online retailer is going to go really well, quite frankly, and that their sales are going to increase, their margins are going to improve as they move away from that brick and mortar type of business, and that their earnings as a result in cash flow, which is really all we care about for a company, how much money it's making, you think that's going to get better down the road as a result of this transformation. So what we did to analyze that first idea, which is that, okay, I think GameStop is a good value because the company is going to get better, is we took a look at GameStop's, GME, STOCK, spelling is tough, at 10:30 p.m. apparently. 8.24 billion market cap. Now, when we were looking at the video earlier, or when we were creating the video earlier, rather, it was 8.8 billion. But then the other thing we want to look at is, I guess from a stock perspective, market cap, outstanding shares times the stock price. That is essentially the value of the company. What is another way to find the value of a company? As in, what is a good way to, we should compare this to another metric that's based in the financial statements to actually figure out if the stock valuation matches an appropriate valuation for what the company is actually doing. So what we did right there is, let's see, EBITDA multiples by industry. This is really one of the most common ways to value a business. There are 3 ways to value a business. Typically in finance, it's discounted cash flows, which is a similar type of financial statement analysis. There are precedent transactions where you would look at something like you would look at if a company similar to GameStop was sold, what did that sell for? And then there are comps where you would look at comparable companies to GameStop. We got a comment to check out finbox.com. They run a few valuation models to show you ranges, and they also show you their assumptions, which you can change. That is a very, I guess, on-topic comment from that username. Very appropriate comment based on that username. Welcome, Quasar Invest. I hope Quasar, it's late. I'm sorry if I got that first part wrong. I probably need to learn more about pronouncing things in space. But great suggestion right there from Studying Right Now CFA. We're going to jump into finbox.com just because I want to see what this looks like. I'm very interested. And we may have to log in or sign up, it looks like. But from a high level, yeah, it looks like a little bit of a scanner feature in there. You could research companies and monitor for market movements. And I'm assuming view and edit financial models. Yeah, it's right in there. So that's definitely something. Quasar. Okay, we've got you. Quasar Invest. And hopefully Quay was pronounced correctly too, or else I might just be losing my mind on stream right here. Okay, let me copy. Okay, /GME. Open this without even having to sign up for anything. This is really interesting, and this is a lot easier of a way. Glad we nailed the pronunciation. This is a lot easier of a way to essentially do what I was doing verbally, but you've got all the income statement numbers here, market cap, dividend yield, and I'm assuming the models, the models are going to be up here. Click on the model gallery. We could export this as, cool, Excel, Google Sheets. That is incredibly interesting, and I think is something, thank you for suggesting this. This is something I did not realize existed and kind of just at a high level did on my own. So this will be a really good supplement to a lot of the valuation type analysis that we do. So let's get back into how we walked through this in the video. So like we mentioned, there are a few different ways. This is really similar to a DCF in the sense that it analyzes the company based off financial metrics. And one of the most popular is EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So what you do from an EBITDA multiple perspective is you take a company's EBITDA, you compare it to companies in similar industries, and then you multiply it by what's called a multiple. And based off that multiple, if you multiply EBITDA by the multiple, you should get the value of the company. So what we have right here, based on the share price, if we're looking at valuation from a stock price perspective, it's $8.24 billion. If we take a look over here at the EBITDA perspective, we're going to call this, the industry I believe we used was computer and electronics retailers. So those trade at a 10.3 multiple, meaning that if the value of GameStop truly is $8.24 billion, as implied by the market cap as of market close today, then they need to have an EBITDA of 8.24 divided by 10, which is $824 million of EBITDA, which I don't think in the quarterly financials we looked at they present, so we'll call it net income. And it would be a little bit higher than net income, obviously, because things like depreciation, taxes, interest, all that is baked into the net income number. And just for a little bit deeper explanation, the reason we use EBITDA for something like this is because at its core, from a valuation perspective, it's believed that EBITDA most accurately represents the financial condition of a company, because going back up here to go letter by letter, things like interest, taxes, depreciation, amortization, these are all results of the way the business is structured. You might have a certain corporate structure that changes the way taxes are paid, or you may have different depreciation conventions that changes the amount of depreciation expense year over year. The policy to amortize goodwill or things of that nature, other intangibles might change, which affects the A in there. And then interest is highly related to the amount of debt you've taken out, and a lot of the time, from a valuation perspective, that's removed, because if you were a company that was looking to acquire them, you could just completely change the debt structure, and that's something that happens a lot. Ooh, is that looks like another link for EBITDA info. That is interesting, and I'll take that in. I'll definitely take a look at that later. This comes from the, looks like you have a link to NYU, and that's exactly where they got this stuff from, but from 2019. So I'm assuming what you put in there is a little bit more updated. I just kind of did a high-level Google search, not anything too involved, but something that would give us a good idea from multiple perspective what GameStop will be trading at. But again, keeping that in mind, the fact that they have an implied valuation of $8.24 billion based on the stock price divided by a multiple of 10 means that their EBITDA would need to be $824 million. We know they don't provide EBITDA in their quarterly financials, which are the most recent financials we have. So we are going to be looking for roughly $800 million in net income. So let's see if that is the case. So next question that comes to mind, how do we get to financial statements? And the way you do that is you're going to want to Google SEC Edgar, which is going to give you the company search page. This is the official U.S. Securities Exchange Commission company filing website. Whenever you hear about a company filing earnings, whenever you hear about a company filing information about significant events, it's going to come up on this website right here. So what you want to do is type in HYLN, GME, which kind of autocompletes, but is getting in the way right now. There we go. We've got GameStop right at the top. You're going to click it. And down the left, this could be a little bit intimidating at first to look at, because it's just a lot of numbers and letters that seemingly don't make any sense. But once you go through and look at this a couple times, and by the way, just to justify the multiple we used, the SEC has them. The SEC categorizes companies like this. So they're in retail, computer, and computer software stores. Boom, computer and electronics retailers. That's the exact industry we need to be looking at. Getting back to the SEC Edgar page. So when we pull them up, we've got all the filings down the left side right here. We've got the 8K, which is significant events, a bunch of Form 13G and A, which are statement of acquisition and beneficial ownership. So if someone owns a lot of stock in the company and does something with it, as in purchases more or sells their stake, that's going to show up in here. But what we're looking for as far as financial statements is either going to come in the annual 10K for their annual report, or the quarterly 10Q, which is obviously presented quarterly. So going down the list, we get to the 10Q. This was uploaded December 8th, so this should be for Q3. You're going to click this. It's going to take you to a screen with even more numbers and letters that are seemingly random, but you're going to want to click the very top one under the 10Q row. The rest of these are just exhibits to the financials. So we'll click on this, and this will take us to the financials. As you can see, quarterly period ended October 31st for GameStop. So we're looking at the Q3 financials. Again, with that valuation in mind, we are looking for $800 million in net income or EBITDA in order to justify the valuation based on the stock price. So stock, let's scroll down a little bit, and the financial statements are presented right off the bat for us. And just a little bit of a brief, let's see, we got a comment. If the thesis is that they will become an esport gaming hub, would you still value them at a computer software store multiple or like a gaming multiple? That is a great question, and it was something I looked at, and I think the category that I would have put them in is e-commerce is what the conclusion I came to, which in my research traded at a 3 or 4x multiple. So I thought what I picked was being a little bit generous. But as far as esport and gaming hub, it's tough. I think the link you gave might have a little bit better of an explanation here, or maybe a more detailed list. But the only gaming is, internet gaming, which might be casinos, but that falls into there. So maybe internet gaming, I mean, hell, we can call it a 19.63 multiple. I don't know if the description that they're going for with internet gaming matches what they may be trying to pivot to, but even if we wanted to get generous with the 20x EBITDA multiple on GameStop, that's still we still need 400 million of net income or EBITDA on these financials. But let's take a look as we go through them. Balance sheet obviously presented first. So what we see right here is we take a high level look. They've got 2.6. Again, these are presented in millions, so don't let the small numbers fool you as you go through these. 2.6 million in total assets, and which objectively 2.6 billion, since it's presented in millions. 2.6 billion in total assets objectively by itself in a vacuum. Not too bad. That's pretty solid and would decently justify potentially the valuation we see. But then we move down to liabilities. Obviously, everything on the balance sheet, as the name suggests, is going to need to balance. So they have 2.3 billion of total liabilities as compared to 2.6 billion of total assets. Not the greatest ratio in the world, which leaves a measly 332 million of stockholders' equity to balance it out. So even more concerning than the ratio of assets to liabilities is the ratio of current liabilities to total liabilities. They have 2.3 billion in total liabilities and 1.6 billion in current liabilities. And high level, what is a current liability? It's something that you are liable or obligated to pay in the next 12 months. So a big chunk of this, accounts payable. That's just typical bills and things like that. The second line, accrued liabilities and other current liabilities. That is something, just an obligation they owe to someone else. We've got a couple 100 million of lease liabilities and then short-term debt. So that is something that is a little bit of concern, that they have essentially 1.6 billion in liabilities coming due. Yet their current assets, which is what we typically look at from a financial analysis perspective, since this is their ability to pay, is 1.65. So they have 1.65 of current assets and 1.57 of current liabilities, which leaves them with only roughly 700 or 75 million in what's called working capital, which is current assets minus current liabilities. And that's kind of one of the better ways to evaluate a company's financial health. So that is not the best to recap on that. But let's move down to what we're looking for. Again, we're looking for this 800 million in net income, potentially 400 million in net income if we wanted to get generous with the multiple. And here it is. And in fact, you get a little bit of spoiler here in the description. They have a net loss. So how this is presented is the 13 weeks ended. So this is just Q3 by itself. They lost $18.8 million dollars. Sorry, that would have been a huge loss, billion. But for the 39 weeks ended, which is, Q3 year to date, so January through October for all of 2020, they've lost $300 million, which, compared to last year, they lost $500 million at this point, but I'm not so certain that a company who's losing $300 million should be valued at $8 billion. And this is where we start to poke holes in the valuation that the stock price suggests. So, just going line by line here, net sales, $3 billion in sales, roughly, pretty solid. $2.1 billion cost of sales. We might imagine that either this or the SG&A line will decrease as they move more to potentially e-commerce and shift their business, but that's not really something that's a given. Their margins aren't horrible. They're pulling 810 million in gross profit off 3 billion in sales. That's really not too bad at all. The issue is just this SG&A line item, selling general and administrative expenses, of $1.1 billion. So the question might be, okay, well, what goes into this line item? Typically, this is relatively static year over year. They were able to knock it down 400 million between last year and this year, which is pretty solid improvement, to be completely objective when we look at this. But you might say, okay, well, the fact that they're restructuring and transforming their business might create some unnecessary costs. So let's look exactly how many costs that restructuring is creating. So we're going to go to page 24 here. And this is consolidated results of operations. Again, just fancy finance speak for an income statement. We've got the same SG&A, selling general and administrative expenses here, 1.1 again. So there's the number we were looking at before. And what it does is it breaks it out down here and it says, okay, SG&A, selling general administrative expenses. The prior year quarter and year-to-date periods included 14.4 million, so 14.4 in the prior year quarter, and 47.5 million, so year-to-date. So this is the 2020 number, respectively, of costs associated with our transformation initiatives and severance. So they tell you in the financials the exact amount of money that's associated with those transformation initiatives, and it's 45 million, which is a pretty small piece of the pie, less than 5% compared to this 1.1 billion of SG&A. So really, I don't think we've begun to see the potential increases in costs related to this transformation, and that's something I'd be wary of going forward. But long story short, this is all just to hammer home the point that this stock isn't worth 8.24 billion market cap. Something's got to give, and I think a much more fair valuation would be, even backing up beyond this, kind of where it was back in the 20 to 30 range. Let's see analysis on the Petco S1 filing. That one we might have to save for another time. We're coming to the back end of a little 2-hour period here, so I was trying to wrap it up around 11 Eastern, but I'll definitely throw that on the list. Hopefully you could do a little bit of analysis on that one in the future. But backing up at why we're looking at GameStop, we said, okay, there may be 2 reasons you would want to buy this stock. The first is that I think it's a good value and the company is going to do well. I think based off everything we just looked at in their financials, we could confidently conclude that even if they did well, it would take a huge turnaround. They'd have to go from a multiple $100 million loss to 800 million of profit. So that would be one turnaround, and that would be just to get them justifying the valuation they're at 120. So I think that thesis is completely off the table if you think, okay, they're going to turn around, the company's going to do well. I mean, that could be objectively true, but it's already a huge turnaround has already been reflected in the current stock price. So I wouldn't buy based off that thesis. And the second thesis is the one of the short squeeze, which is what we addressed when we were looking right here. And I think based off this, like I mentioned, is kind of a legitimate, potentially decent thesis that you could work off of. So could it squeeze? Yes. Do I know how high it could squeeze? Absolutely not. I don't think anyone could have told you, yeah, I think based off tactical analysis and historical blah, 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 that this is going to get up to $500 a share. The thing about the squeezes is no one really has any idea. You just know that it's going to come down eventually. And if you are investing at 120 with the potential for that, sure, I think the factors are in place for that to occur. But then there are a couple reasons why it might not occur, which obviously, based off what I think it's definitely not likely that it does occur. But that's not to criticize the legitimacy of someone who thinks that it will occur. But the reasons I don't are, right off the bat, what happened last time that GameStop squeezed? It got up to about here, and then broker just said, okay, you can't buy GameStop anymore. And that kind of nipped it in the bud right there, and a lot of the hedge funds were able to cover their short positions, which apparently they've loaded back up on, but it just seems like there's a little bit too much of a regulatory or just brokerage imposed risk of something like this happening. Even if the mechanisms were in place for this to explode up to 1,000, could the systems that we use to trade actually support that kind of a move? And I think even just from the move up to 500, we have been told that that is not something that could really happen. And then the other thing that I wanted to address as a reason as to why it might not happen is we talk about the borrow availability, and this is directly tied to the amount of shares that are available just on the market, period. Let's go back to their balance sheet. As we mentioned, with the relation between the current assets and the current liabilities, I mean, it doesn't look good. They don't have a ton of current assets, which, cash is a current asset, available to pay off these obligations that they have coming due. And this is why for a decent amount of time, a lot of people thought GameStop was heading to bankruptcy. But one pretty easy fix to this would just be issuing additional shares at this insane valuation that the stock price implies. And I think the first time they didn't do that because the CFO who was in charge said, I don't think we should do that. Since then, some things have changed a little bit. I don't know if I could find it in the news cycle here, but I'm going to have to scroll a little bit. Let's see. Can't see it right here, but long story short, hell, I could just Google it really quickly. Jim Bell was his name. I thought that was his name. Yeah. Okay. So 6 days ago, he was essentially pushed out in what they call a resignation. Obviously, corporate speak for, you're fired, but we're not going to do that. A good suggestion, they can refi their liabilities, I'm sure, maybe. I mean, a lot of that is based off whether or not the lenders actually feel that they have the capacity to pay off that refinanced debt. So that's something they could do. Refinancing short-term to long-term debt is definitely a legitimate strategy, but I think the path of least resistance here would just be to issue more shares. Because, I mean, it doesn't cost them $1. It dilutes the company slightly, but for the valuation that they would get for these shares if they issue would be phenomenal. Give them enough cash to satisfy those liabilities and give them plenty of cash moving forward to pay for all the transformation initiatives that they're trying to put into place. So that really is the second reason why I think GameStop's really on the way to potentially issuing more shares with this inflated valuation at some point soon, which increasing the supply of available shares would kind of nip that short squeeze thesis in the bud. So that was, in short, pretty much what I went through when I made this GameStop video. For today, that we'll be putting out tomorrow. There are a few more intricacies we went over in the video. If you do want to watch that one when we put it up, we always appreciate the views. So if you do, I'm not going to discourage you from clicking on that one just because you saw what we were doing in here tonight. But that is the conclusion of the GameStop analysis we had. And definitely studying for the studying right now for CFA. Appreciate those comments that you had in the chat. I thought that was some good discussion from a fundamental perspective on a company that a lot of people are just, the extent of what you see on the news about it is just, oh, moon, rocket. Okay, yeah. Maybe let's put some context and some numbers behind these investing theses and take a look at what it actually means, what you're actually investing in, and what the risk to reward realistically actually is. And to me, it's just not a great trade-off with it already at 120. You're just betting on a short squeeze. All right. Yeah, no shout out. Definitely no, I guess no commas. Was the username already taken? We'll have to see. Let me pop back into our Discord really quickly to make sure I'm not missing anything too crazy here. All right. Yeah, I think that pretty much covers everything I had written down that we wanted to go over. We're getting to the back end of the 2-hour session. I am planning, hopefully, on doing this again tomorrow night because I know we put up a poll about when people wanted to watch a stream. And Tuesday and Wednesday night at 9 p.m. we're almost, I think, dead even in votes for the poll that we put up. So if some more stuff happens in the market tomorrow, we've got some more analysis that we want to see done. I'm probably happy to jump on a stream and we'll do this all over again tomorrow night. But if it does turn out that this is the last one, appreciate you guys. I guess last one for the week, not ever. I do enjoy getting on this with you guys, going back and forth a bit in the stream and just talking stock market after, there's nothing else to look at stock market related once that after hours trading session ends at 8 p.m. But appreciate you guys who did jump on this one, and hopefully we'll have another solid day in the market thanks to UWMC. I hope it holds that price for our sake and the sake of people who have been following us along on this little journey that we've been on with UWMC, and it's definitely been a journey the way that chart has looked. So that's all we've got for tonight. Once again, thank you guys for tuning in. Thanks for everyone who followed us during this. And we got a couple donations, so appreciate those. Those are always helpful. We're always happy to make you guys money. It doesn't cost us a dime, but we always love it when you guys give back a little bit too. So really happy to see that as well. So with that said, that's all we've got. So I'll leave you with the YouTube video sign off saying this has been the Hourglass Trader, where as time passes, we make money. Thank you guys.